So this week, let's start our update with a 1 week chart of the S&P 500, and we can see exactly when the Fed meeting was. Those big long red bars in the middle of the screen over here. You see this one over here, this peak way up here? That was the Fed decision, and because of some of the language they used, there was a rally, and then Powell started talking, and then, well, all of that faded away. Carried into the next day, and then Friday, you had a slight recovery, but it still didn't help on the week. Week was down about 100 points. However, even though the index was down, even though you had this happening in the middle of Wednesday afternoon, we're going to look at the VIX and see what happened there, because it is telling a different story. So there's our preview of probably, I think, the more important topic we'll talk about this week. But let's go through the week that was. Let's see where we are. Have a look at our rates. Not a big deal over here. The market moves in anticipation of where rates are going to be. The 2-month to the 1-year hit new highs as of last week. The 2-month to the 2-year, I should say. Capital market rates pretty much didn't breach what we saw in late October. The 2 to the 10 is now 123 days inverted. Which is a for duration, that's quite a long period of time, and for depth, 49 points it's not the deepest that we've been in if you look at previous recessions, but it's been hanging around that 50 basis point mark for some time. This is the more critical one here, the 3-month to the 10-year, because it has never been wrong as a leading indicator. Whenever it is inverted, a recession has always happened, not so much for the 2 to the 10. But now it's 11 days, and what I did was, to make sure it was 11 days, is I checked every single day to make sure that it didn't go negative and then go positive and then go negative again, so that it just gives the illusion that it was negative for 11 days. It was negative for all those days. 11 meaning, of course, we're on Sunday, right? So if you count them out, to Friday was 9 days, but now it's Sunday, so it makes 11 days. 11 days negative, but I mean, it is trying to go in the right direction, so keep your eye on this slope right here. As far as the FOMC, we got it behind us. The next one 38 days away, so we've got quite some time before we get there. FOMC minutes we get in 17 days. Those will be interesting to read, but other than reading what was going on at the time and what the thinking was, I think we know what the thinking is. We got a lot of Fed speak coming up next week and the week after, so much of the thinking that was going on in the minutes will show up in these speeches and in stuff we already know. So when we read it, we might get some little glimpses of the psychology in the room and what they're thinking, but I don't know that we're going to find some silver bullet that says, aha, here it is. This now we know. I don't know that it'll help too much. Fed balance sheet. Continuing on, down another almost $34 billion. The total now is $8.156 trillion, down from 8.19. It just seems like, there's such big numbers, right? It's like every week is like 8.15. Weren't we there last week? No, it was 8.18. So it is going down. It's going down slowly. I don't expect that we'll see a 7 handle on this till end of first quarter, beginning of second quarter 2022, but that'll be an interesting day. I'm sure it'll be a headline story. Oh, the Fed balance sheet is now 7 trillion instead of the 8. We've crossed the 8 trillion down into 7. T-bills dropped 2.26 billion, treasuries 28.8 billion, and floating rate notes 2.76 billion. Nothing on mortgage-backed securities because they have maturities and payments once a month. So we haven't hit that date yet for November. The probability for December fixed, roughly 50-50. 52% on a 50, 48% on a 75. The 75 is still alive here. We get CPI this week, so I don't know that this is going to change significantly until we get CPI. The midterms might change it, and I think if the polls are correct and Republicans do a sweep, I think you'll see more weight head to the 50 basis points on December than from the 75, but if CPI comes in hot, you can expect that weight to shift to the 75. If it comes in light, That'll also shift more weight to the 50. For year end, because there is no probability of 25 basis points here, at least not yet, there is no possibility of ending at 4.25, so that probability is 0, down from 2.6% last week. So 4.5 and 4.75, and since it is the December meeting, is the year-end meeting, it's going to match the same probabilities for the rate hikes. And Fed funds futures. This is a rather interesting story here. So the message we got from Powell on the press conference, and by the way, Powell really, I think that was his, peak performance here. You know, if we think of him as an athlete, he's getting better and better each time. He's certainly not going to repeat the mistakes he made before. They had a very difficult task. They can't keep going 75. They know they can't keep going 75. They have to signal that they're slowing down. And in the statement, they did make the signal that they are considering how far they've gone so far. That's a signal. Market rallied. He came out and he ripped the market to shreds. Because remember last week I said he's got a difficult job ahead of him here. He's got to slow down at some point, but he's got to shut down any rally that happens off of that. So he did a fairly good job with that one. So Fed funds futures last week, May peaked with an implied rate of 4.885, meaning that we would be somewhere between 4.75 and 5% as a peak rate. Well, now that May is now June, peaking at 5.095, which means we'll be somewhere between 5 and 5.25%, as opposed to 4.75 to 5. And it's 1 month further out. When you look at December, last week we looked at a December 2023 implied rate of 4.485, which is somewhere between 4.75 and 5. We're 4.25 and 4.5. We're 4.85, which puts us between 4.75 and 5 now, which is 50 basis points higher than it used to be. It's important to note that this is not what is going to happen. These are Fed funds futures. This is the market suggesting that this is probably going to make sense. That this is what they think is reasonable given where we stand today, but it could be too much. It could be not enough. If we do accept, you know, this is basically what the market is saying to us for June. 5 to 5.25. We are at 4% now, which means you're looking at another 125 basis points of moves. So if you go 50 in December, you're looking at the first 3 meetings of the year at 25, 25, and 25. That seems where the weight of the market is right now. So there's still more upside. So if you're thinking now's the time to move into some bond funds, it still might not be time yet. I don't know that it will be interesting until after the December meeting. Let's read the statement and we'll see if we can find that line on which the market decided, aha, let's rally. Okay, first paragraph, I just highlighted some keywords here. Modest growth. Job gains have been robust. Unemployment rate has remained low. So far, those are good things. Inflation remains elevated. There's your problem statement. Goal, maximum employment, inflation rate of 2% over the long run. You're saying this is our job. The maximum employment, based on what we set up here, seems to be done. We have one task, inflation at the rate of 2% over the long term. They have not changed their inflation target, still 2%. There is some thinking that to get their job done sooner, they can just accept the higher inflation target. Maybe they'll move it to 3%. I don't think so. I think they'll fight the fight until they see that it's something more structural. Then maybe if they decide that we're in a new type of inflation regime, they may change their target, but I highly doubt that. Ongoing increases in the target range will be appropriate, so they can continue in the direction that they're going now. Sufficiently restrictive to return inflation to 2% over time. Well, if they're saying that ongoing increases will be appropriate and they want to get to sufficiently restrictive, we can imply that they don't think that where they are right now is sufficiently restrictive. This is new. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial development. So this last one here is we're going to be data dependent. We're going to, monitor the data, and we're going to see where that leads us. The second last point says we know this stuff works with a lag. All you people on CNBC saying what the Fed doesn't understand is that this stuff works with a lag. No, we get it. We know that. We're the ones who told you that you're now repeating it on TV saying that we don't know that. We get that. It works with a lag. And the other thing that you keep pointing out is, hey, we've gone a long way so far. The Fed has to realize that. Well, we do. We know we've gone a long way so far. We know it works with a lag. But this is new, saying we are going to take that into consideration when we make another decision. We're going to be data dependent, but at the same time, we're going to say, well, this stuff does work with a lag, and we have come a long way. So the market took that to imply that there is the signal that the Fed is going to slow down these rate hikes. Still traveling in the same direction, but is going to slow down the rate hikes. The 75s are over. The next one is going to be 50 or 25. At least that was the thinking. And the market rallied on that, which I'm sure Powell was aware of from the time that he made the statement to the time he walked in that room at 2:30. I doubt he would have walked in without saying, how's the market reacting to this? I'm sure he was aware of what was going on. It rallied into his 2:30, and then it started selling off, but then started rallying while he was talking, and then really sold off. Committee is strongly committed to returning inflation to its 2% objective. So because this was new, the market will take and assimilate any new information. Everything else was expected. That was, and the belief is in efficient markets, that's priced in. The new information was this line. That's not priced in. Let's go higher. Okay, real yields, all of them up this week. Only one, the 10-year, set a new high last week. Not much change in the break-even rate, so I'm not getting much of a signal from any of this. This is consistent with last week's performance in the markets. Higher real rates mean a lower present value of all future cash flows on a real basis. So we should see lower valuations. The market was down last week. S&P did lose value last week. It's consistent. No divergence there. When things are consistent, there's really no signal. It's when you have a divergence in the data that raises the question mark of what's going on here. Let's go down here first. Last week we got 3 different data points for the jobs market. Let's look at initial claims, 217,000. Before we saw the jobs data on Friday, I said the only missing piece of the puzzle here was the initial claims for October, but based on what we saw, 219, 226, 214, 218, there was no way that the jobs report would have come in negative. So the household survey did. So we've got to kind of fix this anomaly going on here. But let's stay with this. This is seasonally adjusted, 217, non-seasonally adjusted, because this here is an exact number. You can count the number of people who show up and say, hey, it's my first time. Here's my report. That's the initial claim. That's when you first show up and say, I lost my job. Give me some money, please. You can count those. So if we look at non-seasonally adjusted, 178 to 184 to 185, increase week over week of 1,174. It's not a lot. The seasonally adjusted just takes into consideration that there are some months where, based on the structural setup of the economy in different industries, there are natural seasonal effects. Well, you don't want to be counting these seasonal effects, because month over month it'll look like, oh my God, things are very bad, and then the next month, oh my God, things really improved. You want to sort of smooth that out. The JOLTS, the job openings are now at 10.717 million. The expectation was 10 million. So the demand for labor is increasing. Quits rate 4.016 million, still over 4 million. This here, I know you can't read it very well. I didn't put the chart up to be read. I just put it up just so that you could see the major trend in it. This is a 1-year bar chart of it. This is last October, November, December, January, February, March, April, May, June, July, August, September. So you can see that it is coming down. The quits rate is coming down. So it is moving in the right direction. You still have job openings elevated over 10 million, but there is, some debate over whether or not those are all different jobs. Or if it could be a company that posts a job for a senior developer in every single place that it possibly can, and perhaps that job is being 2, 3, 4, 5 times counted when you add up all these job openings. It could also be, and I know that there are some companies who do this, that have perpetual job listings, especially in IT, where they're not looking to hire somebody tomorrow. But what they're looking for is a unicorn. So they'll have this job posting up, which almost nobody qualifies for, or there's very few people, or if they exist, they're already hired by another company and they're not going anywhere. But they'll put it up just to say, just in case someone like this comes along, we would hire them in an instant and maybe get rid of somebody else we have, a lower performing person. If we could hire better, we would. So maybe the job openings that are out there are for existing jobs that are already filled by low productivity employees. That, look, we'll hire these IT people because we need something now, but we'll have to hire 10 of them. But if we could hire 3 really good ones, we can get rid of the 10. So there might be job openings for jobs that are already filled. So there is some debate as to, are there really 10.7 million jobs available right now? Without any of them being double counted, some of them being just for unicorn purposes. The big discrepancy here, and I think we have a whole bunch of measurement issues. I don't know so much that any of these that we would say, well, which one is true, which one is false, as opposed to which one is most subject to a measurement bias. Household survey, unemployment rate increased 0.2 percentage points. We're at 3.7, which is still historically very low. Number of unemployed persons rose to 306,000, or rose by 306 to 6.1 million. So the household survey is saying 306,000 people, or 306,000 jobs were lost. The establishment survey is saying 261,000 jobs have been gained. The average per month so far in 2022 is 407,000 per month. Compared with 562 per month in 2021, so it is slowing down. 562 per month in 2021, it's going to 407 now. I also put some key measures from the jobs report up. Average hourly earnings, month over month, up 0.37. Yes, I have 2 decimal places, Bureau of Labor Statistics. Do you see what I'm doing here? I'm putting in 2 decimal places. Look at the information content in that. If you annualize that, you get to 4.53%, which is not consistent with 2% long-term inflation. You got to get that down even further. However, it's moving in the right direction. It used to be over 5. Now it's 4.53. So that's a positive sign in average hourly earnings. It is coming down. If we look at aggregate hours, they've increased 0.1767 because, well, you added workers, right? You can have these workers working 40 hours a week, and then you add another worker working 40 hours a week. Well, the aggregate hours have increased. So that's what that's measuring, is even though the work week that they measure, the average work week is still 34.5 hours week over week. You just have more people working 34.5 hours. So aggregate hours are up 0.1767. When you combine it with average hourly earnings up being 4.53, average payrolls are up 0.569. If you annualize that, aggregate incomes in the economy are up 7.05%. That means there's 7.05% more nominal dollars that are available to be spent in the economy over the course of this month because of the combination of more people that have jobs and each hour worked being 4.53% more profitable to the employee for doing it. So this is the amount that can get spent. So companies are fighting to get that share of aggregate incomes. We can't just look at 4.53 and say, well, wages are up 4.53, so companies can expect to see, you know, the revenues go up by 4.53%. You can get 7% because there's 7% more money, assuming a velocity of 1. The higher the velocity, the more it will translate into revenue, right? Okay, let's see if we can figure out what anomalies we have in this data. Let's look at the first one over here. 407,000 average per month. And let's see if it makes any sense at all. For the first 6 months, that would mean you've added 2.42 million jobs to the economy for the first 6 months. But if we look at real GDP for the first 6 months, it was negative. If we look at just the real GDP number, not GDI, but real GDP, came in negative. Doesn't seem to make a lot of sense. Why would a whole bunch of companies keep hiring to produce nothing more? This means that productivity must have really dropped, because now you have 2.42 million more people producing less stuff, because of real GDP is negative. Real measures the quantity of stuff that's put out. You have more people making less stuff, so productivity must take a real hit. Well, we didn't see, we've had earnings for Q1, Q2, Q3 so far, and that's not showing up in margins. Some companies' margins are improving, some are staying the same, some are decreasing, but overall it's not very one-sided. So there's an anomaly here somewhere. Either this is not true or this is not true. Don't know which one it is. If productivity has dropped this much, here's what has to happen. If your input costs are going up 10%, if you want to keep the same EBIT, or we'll call it operating, if you want to keep the same operating income, which is the amount of dollars you make, your quantity has to increase by 10%. If you want to keep the same income. If you want to keep the same margin, not only do your quantity have to go up 10%, but your prices have to go up 10% as well to keep the same margin. So if you have a case where your productivity is dropping, meaning your quantity of output is dropping, that means your price has to go up significantly more than 10%, which makes this anomaly, 2.42 million and negative GDP, highly inflationary. And if we believe those measurements, the solution to inflation is to raise productivity. How do we raise productivity? Is it that we have a whole bunch of people doing nothing? And if we do, it's time to get rid of them because they're lowering productivity. Is there automation or software or something that we could bring in that can increase output? If we believe these particular numbers, we don't have an inflation problem, we have a productivity problem. Hence, solving inflation means solving productivity, not destroying demand. If that is the case, then that means that this is not a central bank issue, this is a private industry issue. Well, private industry is pretty smart. That if this were the case, if they saw this going on that large scale, at aggregate like that, actions would have been taken. But we're not seeing that. Oh yes, we're seeing layoffs, but no more than what would be expected at other times. It's not significantly higher. It's not affecting the jobs report, unless of course you believe the household survey. That's negative 306. Well, you know, if we look at the household survey, it is saying that over the course of the year, you did not create. If we have 407,000, and this is saying it's been like that so far in 2022, this is for October, that's, I'm going to need a new place to write here, that's 4.07 million. Well, the household survey is nowhere near 4.07 million. So you would say, if we accept real GDP, the household survey data is closer to it. And if the household survey data is closer to it, then we don't have that big drop in productivity. And if you don't have that big drop in productivity, it's not as inflationary, which means you wouldn't expect to see companies do too much, which is consistent with what we're seeing. But if instead you say there is a measurement issue in real GDP, we need to use GDI. GDI for the first 6 months was positive, which is consistent with the establishment survey data. but not so positive as to say, hey, the economy is producing more income with fewer employees. It would be inconsistent with the household survey data. So if we believe GDI, you have to believe the establishment survey data because they're consistent. If you believe real GDP, you'll side more with the household survey data because it is more consistent, because the one thing we really haven't seen yet is an aggregate deterioration of operating margins. Oh, you've seen idiosyncratic decreases, but you've also seen companies that were able to increase their margins. So last week I showed you CAT. CAT was a good example of a company that could increase its margins. Pulte Homes increased their margins. Some companies decreased their margins. Some people pretty much, or some companies, I say people. Well, organizations are people under the law, right? They're individuals under the law, so maybe same thing. But we're not seeing it on aggregate. Well, I don't think there's a measurement error there, which means there's a measurement error somewhere. If you believe real GDP, you're more likely to believe the household survey. If you believe GDI, you're more likely to believe the establishment survey. Let's look at the jobs report, see if we can't get any more information out of that. All right, employment situation for October. Household survey data. Unemployment rate, we saw this already. Number of unemployed persons rose by 306,000. Labor force participation rate at 62.2, which is down from 62.3, not going in the right direction. And as I've said before, the biggest supply constraint we have is on labor. Either we have to replace a whole bunch of jobs with computers and machines, or you got to get that labor force participation rate up back to the 65% level, 62.2. This is interesting here. The number of persons not in the labor force who currently want a job, 5.7 million in October. So they're not in the labor force. They're not in the labor force participation rate. It's 5.7 million. If we look at the unemployed as being 6.1 million it's set up here. The number of unemployed persons rose to 6.1 million. You got another 5.7 million that are not counted in the labor force because in the last 4 weeks they did not actively look for a job, but they are unemployed. It says they currently want a job, but they're not counted in the labor force because they haven't looked for a job, which I think is kind of odd. It's like, do you want a job? Yeah, I do. Are you looking for one? Nah. You know. Anyways, another 5.7 million there that if we say, if they suddenly were, if all of them at least made one phone call, hey, can you give me a job? And say, yeah, I looked for a job in the last week, this participation rate would increase. So maybe, you know, with the count, the way they count, the participation rate is actually higher, which would lend some credence to the thesis I have that the jobs that are available have a higher cognitive burden today than those same job openings, or that the same number of job openings would have had 15 years ago, that there may be just a structural movement away from very low-skilled people who simply can't get a job in this knowledge-based economy. That, you know, that could be a reason for that, which means that this 5.7 million is probably closer to becoming what is called structurally unemployed. Establishment survey data, payrolls increased 261,000 in October. Monthly job growth has averaged 407,000 so far in 2022. We saw this already compared with 562 in 2021. And it breaks it down: healthcare, professional and technical services, manufacturing. I've highlighted some numbers in our data here. Here's the household data. If we're looking for the loss of jobs, it's right here. The employed, 328 lower. This is seasonally adjusted from September to October, 328 lower. Let's go down to the establishment data, which is in B, total non-farm. You can see there's the 261. And it breaks the 261 down into three categories. Goods producing industries added 33,000. And there we're seeing zero inflation. If we looked at CPI for October, the October report for September, we saw the goods inflation really was flat. Everything was in the services inflation. Well, this is consistent with that, right? You're only adding 33,000 in the goods producing sector, but 200,000 in service providing industries and 28,000 for government. And I think that was all that I highlighted in there. Yeah. If you keep going down, you'll get to all of these other interesting tables. Oh, I got more here. Household data. So we're back to the household data here. Participation rate, 62.2, 62.3 in September, 62.4. So that's going in the wrong direction. You had 62.1, 62.2, 61.7. It hasn't really budged much from 61, 62. Unemployed, there's the 6.1 million, 6,059,000. And this is persons who currently want a job, 5.7. So when we look at the JOLTS data saying 10.7 million job openings, and then there's the statistics saying that is, almost 2 jobs per person, that is using the 6 million. But if you add the 5 million to it, you get close to 11 million, 11.8 million. There are 10.7 million job openings. My big question here is what's going on with this 5.7 million? They want a job, but they haven't been looking for a job, hence they're not being counted as in the labor force. I'm having a difficult time with 5.7 million people saying, I want a job. Have you looked? No, I haven't looked. Is it that they think that the economy is so good right now that they can just, that their intention is to start looking, but they haven't felt the need to start looking? I don't know what that is, but there is some potential there unless these are individuals who are demotivated. In other words, they simply can't be hired. They're unhirable in today's economy. It could be that, and that they would like a job, but they simply just are not qualified or capable of getting a job for whatever reason there is. They're simply not capable or qualified. And then if you're interested in more demographic information, that's broken down into demographic information. Interesting charts if we get past the demographics and the identities. If we get down here, let's keep going. Nope. Again, no. I believe it breaks it down by industry at some point. There it is. Thank you very much. By industry. I was going to say, I'm pretty sure I saw it. There it is by industry. So if you're interested in particular industries, or you are investing in particular industries, you can see the direction they're headed in, whether they're hiring or not. So we can see construction, residential, non-residential. We can go across for residential. Change, 2,400. Construction of buildings was 5,600, and it breaks it down into residential and non-residential, 3.2, 2.4. Construction, 1,000 overall. Were we losing? Heavy and civil engineering, negative 0.4. Specialty trade contractors, down 4,000. Residential specialty trade, down 1.5. Non-residential, down 2.5. So you get a little bit of extra granularity here per industry. So if there's some industries you're interested in, it just has a whole bunch of data in there for you. Okay, let's look at OAS. The OAS is consistent with the VIX. This is actually an editing error here. This is as of 03/2022. As of Thursday night, as of Thursday, the end of day, the S&P was down about 150 points. We got back 50 points on Friday. But for being down 150 points, this is the change in spreads. Big yawn. And we also saw that the VIX didn't really care too much about that either. So these two things are consistent. There doesn't seem to be a lot of concern here. Let's look at mortgage rates. The 30-year fixed is 7.29 now versus 7.08. Still sitting a little under its high here at 7.37. FHA 30-year mortgage 6.84 versus 6.62. Still sitting under its high, but the adjustable rate on the 15-year fixed, not very common by the way, sitting at their highs. Mortgage applications last week down 0.5%. We're so used to the negative numbers. Refi is up 0.16. Call that zero, really. Purchase down 0.8. You can call that zero. This is so close to zeros to say, look, there's just no activity going on in the mortgage market. If we look at housing, and we're going to look at the October housing trends because that is compiled by Realtor.com, but this is for the week ending October 29th. 2022 year-over-year change for this week over the same week last year. Median listing price is still up 12%, but over the last 3 weeks it was up 13.2, then 13, now only up 12. So they are coming down, but this is, I think, partly due to the lowering of the transaction price for the home and the disappearance of the base rate. As we go further and further, base rates will continue to lower that price. So even if housing prices remain flat because of the base rate year over year, it will give the appearance that month after month or week after week we have less and less of a price gain. But this is moving in the right direction. New listings are down 13%. This is 7 weeks in a row now that it's been negative. However, active listings are up 40% over last year and moving in the right direction. It was 34%, then 36%, now it's 40%. And time on the market, 6 days slower. So that means it's taking 6 days longer to sell a house over for the week ending October 29th versus the same week last year. Let's look at the October housing trends. All right, month of October, active listing count on Realtor.com, 753,000, up 33.5% year over year. And the green line down here is 2021. The teal line here is 2020. So now it's above 2020. Last month it wasn't, but now it is. But put things in context, here is pre-pandemic. You're somewhere between 1.2 and 1.3 million, given that it's October. And we're here at 753, so it is much lower than pre-pandemic. Next, we have total listing counts tracking very well with 2021. And up here is the pre-pandemic level. So if we move from October up here, we're 1.6 to 1.65 million. Here it's 1.16 million. Pending listing. Pending means an offer was accepted on a house, but the transaction has not closed. It's still pending. It's dropping, but there we can see there is a, because of the inverted U shape, there is a seasonal pattern for this, and it's showing the same thing, although at a faster clip downwards than in previous years. Newly listed homes, this speaks to supply, down 16% year over year this October versus last October. You know, you're looking at the housing market and you know you're not going to get the prices you had 6 months ago. And if you sell this house and buy another one, if you got to, get a new mortgage, you're getting a new one at 7%, not at the existing rate you have now, which might be 4% or 3%. So there's little motivation to newly list your house now. If you don't have to, you could say, oh, let's just stay here for a couple more years. But this is tracking the seasonal pattern as well. Days on the market, it is still, you can see the market is slowing down, considering way back in May, 30 days. Well, now it's taking all, a little less than double, I should say, 51 days. But let's move up here to 2018, 2019, there's 2017. You're somewhere between 68 and 75 days. So 51 is still a much better market in terms of how quickly your house can move versus where it was pre-pandemic. Median listing price, it is coming down. This is the price that it's listed at. This is not a transaction price. For that, we would have to look at a housing price index. We already saw that last week. We saw the housing price index, NK Schiller. Those track transactions. This is just the listing price, but we are seeing expectations coming down. The listing price is dropping from somewhere around 450 down to 425. But if we look at October over, well, we don't have a full year here. We can go all the way back to January, 370 roughly. So we're still sitting at 425. So if the listing prices and the transaction prices, especially the transaction prices, if those can go sideways for a while, base effects will take care of the measure of inflation in the housing market so that we can see housing and owner's equivalent rent drifting towards zero over the next, let's say, 7 to 8 months. It would take about 7 to 8 months to get there. If they go sideways from here, if they drop, if they start dropping, it could accelerate with base effects being removed every month as well. But if transaction prices only go sideways from here, at some point you will have a year-over-year read of 0% inflation. And if they start going sideways, you'll have a series of month-over-month measurements of 0%. I think if the Fed started to see something like that 2 or 3 or 4 months in a row where you have month over month zero inflation in rent and owner's equivalent rent and zero year over year because the base effects are gone, I think that would do a lot to you know, kind of suggest that maybe it might be time, you know, in the next little while to start thinking about bringing those rates back down, because that's 32% of your CPI. We've already seen that average hourly earnings are coming down. Wages are growing, but not growing at the same rate they were, let's say, 5-6 months ago. That if housing can solve itself this way as well, you could, by the mid-second quarter of 2023, start to see reads that are consistent with what the Fed says. We want to see clear evidence that inflation is consistently coming down. We could have that clear evidence by the second quarter of 2023. As long as mortgage rates stay where they are, I can't see what would be pushing up the median listing price. But, you know, when we do look at these, you can see some seasonal effect in here. Other than, of course, 2020, 2021, you got to take out. But pre-pandemic, you can see it rise and then slowly drift down into the end of the year, right? Each one. Look at this one here. You're mid 270s, about 290, and up to 320, and then it drifts down into the end of the year back to 3. So this just simply could be, you know, drifting down. You might get to about 420, and then once you get into the spring, you might have this upward trajectory as well. You might have that seasonal effect on the median listing prices as well, in which case, then you're not going to see it drift away by the second quarter. All right, this screen and this topic doesn't flow from the last topic. I didn't know where to insert it, so I thought, well, here's a good place to insert it. I was listening to PBS News in the week, and they had a discussion about the Fed has raised rates, and one person was talking about, you know, what this does to the debt. It's going to make the debt that much more expensive to service. Quoted, you know, the debt's at $32 trillion, so, you know, it's going to cost that much more. No, it's not. That's a very naive understanding of how this stuff works. Imagine you got a loan for $1,000 at the beginning of the year at 3% interest. It's a 2-year loan. You're going to pay it off over 2 years at 3% interest. And now, if somebody went to get that loan, they'd pay 9% interest. They would pay, not you. You already have that debt. You still continue to pay 3% interest. Interest rates are going up, but because you have fixed rate debt, it's not going up for you. It only goes up if you have floating rate debt. Well, most of U.S. debt is fixed rate debt. Most of it is fixed rate debt. Very small amount of floating rate and very small amount of tips compared to the size of $32 trillion debt. Most of it is fixed rate debt. $5.4 trillion is held by the Fed. There's really only $25.8 trillion that is actually costing the Treasury anything, because that $5.4 trillion at the Fed, they receive coupon payments, but every year at the end of the year, the Fed returns all of that income to the Treasury, which makes it zero cost debt. It is zero cost debt. It could be $200 trillion. It wouldn't change the picture. It's zero cost debt. So there's only 25.8, mostly at lower fixed rates. So if the Fed raises rates, they raised rates on Wednesday, all the debt that was issued prior to Wednesday is not affected by that. The market prices are affected by that, which means the investors that are holding that debt have a lower price associated with their debt, but that doesn't affect the coupon payment that they receive. It affects the yield they receive because their yield is a combination of coupon and capital gain. So it would be the yield that the next buyer would realize, still with a fixed coupon. Just the coupon would be lower, so the market price would have to be lower to equal a higher yield. So the government's cost of debt did not increase on Wednesday. The cost of issuing new debt does increase as well. But it's only new incremental debt that has that higher price. But we have inflation. So inflation is good for tax revenue. Let's see if we can figure out the relationship between how much more money the government takes in versus how much money it has to pay out because of higher rates. Nominal GDP for third quarter came in 25.66 trillion annualized basis. The average tax rate per GDP for 2021 was 17.8%. The average long-term rate is 17.1, and here is a chart of that over here. This is tax revenue. The purple is tax revenue as a percentage of nominal GDP. Long-term is about 17.1 right across here. All these dips are recessions. And I drew, you can see in purple here, it's a different color because this chart ended at 2020, but we have the 2021 data. It was 17.8, so I just drew it in to show you what the chart looks like over here. So here is the logic here. If real GDP, our GDP equals 0, and inflation equals 8%, nominal GDP will increase by 8%. So if you're multiplying by the average tax rate of 17.8%, it stands to reason your tax revenues will increase by 8% as well. Because if you're multiplying this number, which is 8% larger, by the same number, your result will be 8% larger as well. This number over here, 5.68 trillion, is 17.8% of 25.66 trillion. Which is roughly about 17.7% of the outstanding debt, but this money has to pay for a whole bunch of operational issues for the government. You got to pay salaries, wages, rent, all that kind of stuff. So it basically pays to run the government. Anything you have left over, you can reduce the debt by. But we have deficits, so the debt is going to continue to increase. And therein lies the headline for news agencies saying, the debt is going up and interest rates are going up. This is going to end very, very badly. Well, you can't look at those numbers. You have to look at, well, what does it cost me to service that stuff? Because sure, the debt could be going higher, but if it doesn't cost me a single penny to service it, let it go up. It doesn't really matter. Let's find out. Again, I said if inflation is 8% and growth is 0, you're still going to get nominal GDP 8% higher, which means your tax revenues are going to be 8% higher. In an aggressive situation where we assume that we turn over 17.7% of our debt every single year, you would have your debt growing at this rate, which means this is the number at which you would look at the incremental costs of financing that. Because of the way the Treasury issues securities, 3-month, 6-month, 2-year, all the way up to 30-year, and the sizes that it has, it averages out very close to the 5-year rate. So what we can do is say, well, this amount of money will be increasing in cost at 4.33% a year. But this amount of money, because of inflation, will be growing at 8% a year. So R is less than G. When R is less than G, the effective carrying cost of your debt is less than 0. That's the beautiful thing about inflation. That is the term where we get the term inflating away the debt. Inflation can do a lot to inflate away the debt because you'll be raising tax revenues by more than the interest cost in rolling over the debt. And if you can be fiscally disciplined and you can say any incremental tax revenue we raise because of inflation, let's pay down the debt, you can get rid of that debt very quickly. Usually in a span of 7 to 8 years, you could get rid of that debt and it's all gone just from the incremental increases. But you have to have a central bank willing to let inflation run at 8% for 7 to 8 years. If you do that, it will become part of the system. Now you have a big problem. So it's like playing a game of chicken with inflation. Yes, inflation is good if you have a high level of debt, and the longer you can keep it going, the better it would be for the level of debt, but the worse it would be for the long-run health of the economy. The sooner you kill inflation, the better it is for the long-run health of the economy, but given the high level of debt, it could become dangerous, especially if you have a recession. Let's look at what happens in recessions. Look at what happened. And here, every sharp drop that you see here is a recession. These are all recessions. This sharp drop you saw over here, this is not a recession. This is the Trump tax cuts. So you dropped your tax revenue, and so as a percentage of your nominal GDP, it dropped. What we don't want to see at this point in time is this. As a percentage, our tax revenue as a percentage of nominal GDP. If we get a recession, this is what you would see. So now what you're going to have is you're going to have a high rate, but you're going to have a negative G going on in there, or a very low G, in which case R will be greater than G. That is going to become a problem. The wider that spread, then yes, that argument that's saying, oh my God, our debt is getting way too expensive to handle, it's taking more and more of every tax dollar to pay for it, becomes very true in a recession. In a recession, though, if inflation starts drifting away, well then this tax revenue is not going to grow at a rate significant enough to offset this. You're going to have positive carrying costs of debt at this point, but you're going to be in a recession, so the central bank would be motivated to lower R, as long as it can maintain R less than G over a period of time. The debt is not that important as long as it can maintain R less than G. It's when R becomes greater than G, it becomes a problem. It will become greater than that in a recession, and in a recession, that will dominate the conversation from Capitol Hill. And if you have the Republicans that are dominating the conversation in Congress, it's going to get uncomfortable for the central bank. They are going to pressure hard to lower rates, So we have that to look forward to, which gives greater importance to the midterms coming up in 2022, because if the Republicans do, as the polls say, pretty much take control of the Senate and the House, yeah, by the time you get to Q2 of 2023, if there is a recession, if we do have this situation, it's going to get loud. It's going to get loud, and there we will test the central bank's independence. There we will test the resolve of the Federal Reserve to continue to fight inflation, especially if inflation isn't gone yet. If inflation is dropping down, they probably will bend to that will. But if it's not, you got a fight coming up. Okay, I got to say a word here about currencies, because Friday was a really interesting day. You had some China news. This is a one-day chart at the top. Some China news about COVID, and some hope that COVID-0 is over, and that you'll have a full reopening of China and it will stay open. And then you had non-farm payrolls, and you can see the change in the direction of the currencies at this point. This straight line down here at the very end of the chart, that's the Friday move on the DXY. This is DXY. Hit a high on September 27th. On November 3rd, we can see that it was a little bit lower, and the resistance, if you extend it out, is 112.71. Of course, that would continue to extend out as time goes on. This is a 10.26 was the low over here. You have support here, 110.28. So you've got about a 2.5 point range on the DXY. We're sitting at 110.88, which is just 0.6 above the support. It's got a long uptrend. This uptrend goes way back to March 2022, so you're still in a long period of uptrend, but you do have what looks like a consolidation pattern going on. The question is this going to be a continuation or a reversal? Consolidation patterns usually follow after a very long trend. You'll have some kind of sideways movement. Sometimes it reverses. Sometimes it's a continuation pattern. It just continues in the same direction. I'm not seeing signs that this is a reversal. This just looks like a consolidation pattern at this point, and I think that you'll probably continue on. So there's the number I would look for. So the question I have, is this a one-day thing, or do I expect this to continue? So on the China news, you had a whole bunch of things happen. You had a rally in Brent. There's your Norwegian krona. It really did well against the U.S. last week. The Canadian, look at that. Well, this is the U.S. Canadian, which means this is the U.S. getting weaker. The Canadian, or the U.S. dropped 259 pips against the Canadian on Friday alone, sitting at 134.76. 135 was tough. It bounced off 135 twice, finished below 134.76. Another daily finish below 135 would then sort of flip it over to 135 as resistance, and this could then get to its next level, which is 132.50, which maybe it does. Canada had great jobs report on Friday, over 100,000. For if you multiply that by 10, you get roughly about the size of the U.S. That would be like the U.S. reporting 1 million jobs. That's how big that number was. And if you look at our yield curves, they're all inverted. Almost every economist in Canada is calling for a recession. Even globally, look at the OECD is basically calling for a recession for Canada. It's basically almost a done deal. We just got to wait for it to show up. And then you get a number like 100,000 jobs added during the month of October. When everyone was positioned for a recession, even our central bank only went 50 basis points, not 75. So there's a discrepancy between the U.S. and Canada in terms of where rates are. Something like that jobs report was huge news for Canada. 259. That, if you're a currency trader, you'll understand that's a huge move on a currency like that in one day. The peso, 19.5, still continues to be the winner of the year. However, not a great performer on Friday. Yeah, it gained, but certainly not a lot. But it did gain, but it was strong all year. There was really no reason for it to be that much stronger because it hadn't been in oversold territory, but it still eked out a gain. But we're sitting at 19.5 now. When I first started pointing out the peso, we were sitting around 20.1 to 20.2. And I said that I'm interested in taking a long position on the peso. 19.5 now. Long means dropping on this rate because that is $1 used to buy this many pesos. Now it's only buying this many pesos. Peso is stronger. The pound, got to say something there. They raised interest rates by 75 basis points. However, in the same sentence, or in the same conversation, they said we are forecasting an 8-quarter recession, a 2-year recession. Now, this is interesting because this is the opposite kind of position that the Bank of England is taking versus the Fed. The Fed raised interest rates and wanted to make it clear to the market that rates are going higher, that the implied rates by the federal funds rate, the implied rate in the market is too low. It should be higher. Bank of England went the other way. They said the rates being implied by the market for how high we're going to go are way too high. We're not going that high. And I think they did that because they need the bond market to rally. They need rates to go down because they don't want a repeat of what they had the last time the bond market sold off, which was, the squeeze on pension funds. Whereas in the U.S., it's the other way around. They don't want a rally to happen because it's just going to make their job easier. I think the Bank of England is looking at this saying, let's make sure we don't have a repeat of that bond market fiasco we had. Let's just send a message out so that bond market participants don't start selling bonds and creating another problem. So I think that both of them are using the market as a tool of monetary policy. There's the Aussie and the New Zealand. They have huge trade with China, so there's the trade response. 3% up on the Aussie, 2% stronger on the Canadian. Well, it's actually a little bit different than 2%, but we'll just call it 2% on the Canadian. BHP up 10%. Rio Tinto up 10%. Freeport McMoran up 11.38%. The ETF pick up 8.78%. All the mining companies on Friday just soared. The question for these now is this going to matter? Is China's stance on COVID saying, okay, here's what we're going to do. If you're a plane coming into the country and you're carrying someone, we're going to go after you. So the belief is, well, fewer cases are going to fly into China. Maybe now we're getting somewhere. Maybe China won't shut down again. Is that rational for this effect? If not, some of these things are worth selling calls on. You'd want to sell calls if you say, I don't believe this move. I don't believe that this is a cause and effect, that this is euphoria. And a lot of this was probably short covering because there were high short interests in these stocks. That for it to be up, for Freeport to be up 11.4% in one day, based on what seems to me a couple of cognitive steps. Okay, China says something about COVID, which means this, which means this, which means this. Okay, I'm going to buy mining stocks. When you are doing this kind of logic and you got to go 2, 3, 4 steps ahead, I don't know. I don't know if you're going to get that kind of cause and effect out there. So because of that, I'm going to watch the opening next week. I was long these guys. I had sold puts on these guys, so I'm more than happy with this. However, just because something like this happens doesn't mean I have to believe it. Just because I was long-term bullish on the miners doesn't mean that I can believe these one-day moves that move 10%. I got to look at that and say, I don't know if I believe that. So I'm going to see what happens over the course of the week. I'm going to see what our Monday move is. And if I'm anticipating any weakness in this at all, I am going to sell 30 Delta calls. I'll probably sell 30 Delta calls on the ETF first, and then I'd probably go to Freeport and sell there. BHP, yeah, I think there. I don't know that I'd touch Rio yet, but BHP and Freeport would be my two seconds, but I'd sell 30 deltas on pick on that one. Again, was this a one-day move in the dollar index, or are we rolling over on it? This doesn't make a lot of sense to me, because on Wednesday, Powell said we're going higher for longer. The job market is way too strong. And then you get the report on Friday, which showed average hourly earnings are up, not consistent with 2%, and we are creating jobs, which was going in the wrong direction. That for the dollar to weaken that significantly on that. But then again, in that jobs report, you could have read it two ways. You could have said, household survey shows negative 306 and average hourly earnings are now under 5%. Everything's moving in the right direction. Maybe we're not going higher for longer. Maybe it was read that way, but it wasn't, the market reaction was not ambiguous. There wasn't a fight on the US, on the DXY that says, no, trading in a range. It was down, which is an unambiguous response. But it could have been a lot of short covering, and on the DXY it could have been a lot of take profit. Actually, it didn't even have to be take profit on DXY. If you're short covering on all these currencies that have been really oversold, it is going to do this to the dollar anyways. I don't know how to read this one yet, but let me draw my little eyeballs, and there we go. I'm concerned. I'm a little concerned with this. I'm looking at it and saying, let me see what comes of this. And if this was a one-day thing, I got an event trade. If this is more than a one-day thing, maybe we got a trend and I'm going to have to rethink some things. But I am more than thankful for the Canadian move. Thank you very much. And I don't mind the peso move. And this really helped me on the puts that I sold. So I haven't been hurt on this, but now I'm thinking, do I want to fade this or do I want to jump in on this? Those decisions could possibly help or hurt me, but so far I haven't been hurt. All right, here is the VIX and the SPY for the last month. We're going all the way out to the beginning of October. This is a 1-month chart up here. And these are inversely related. The purple line is SPY. You can see this move upwards. That matches the move downwards in the VIX. And then you have this rollover in the S&P, and you have very hawkish Fed. This was the Fed day over here. You had the sell-off that occurred after that. But look at the VIX. VIX only went sideways, did not increase. You had a market that rallied on Friday, and you had the VIX down. This is consistent. This is consistent, but this is called a divergence. That's a big question mark. So we have to, slowly pull it apart and say, well, what do we think is going on here? To get there, let's understand what the VIX is measuring. It is the implied volatility of a synthetic constant 30-day at-the-money option. And the VIX is measured second by second. Every second it's recalculated based on a mixing of option strike prices for the next 2 months, such that it's weighted in such a way to create a synthetic at-the-money constant 30-day option. And it's going to use November and December index options. So for there to be an increase in the VIX, there would have had to be an increase in put buying in either November or December options. If not, it doesn't increase. It just goes sideways. If there's a decrease in demand for those, the implied volatility drops because the price drops, and you would get a drop in the VIX, which is what we got. You have a one-day move on the S&P of 1.34% on Friday, but a 3% downward move in the VIX on Friday, matching that 1.34 up, and sideways movement while the S&P was dropping. Very curious. So the conclusion you must reach is demand for puts for November and December did not increase. So market participants are not positioning for a sell-off into the end of the year. And if you were a market participant, here is what you would do. You would buy puts if you expected there to be weakness in the market. When that weakness showed up, you would have no problem selling your positions because you have your puts that are increasing in value at the same pace. So you sell into these things, you're protected by the puts that you bought. If you're wrong and volatility decreases, you can always close your puts at a loss, but it's a small cost to have bought that insurance. If you are not expecting any issue, you don't buy puts. And if you don't buy puts, it's going to show up in the VIX. The VIX is going to drop. Market is dropping. VIX is going sideways. So that means there's no increase in demand, but there's no drop in demand. Market rallies, the downward move continues to happen, so demand is dropping. There does not seem to be fear going into the end of the year, which means a narrative that you're going to hear over the next little while is a Santa Claus rally, that we can rally into the end of the year. This also means something for the premiums that you would get. Here, this is VIX up around 33, 34. You have nice high premiums. Well, you got VIX down around 24.65. You get lower premiums, and 34 down to 24 is a significant move down. There's a third. Your premiums are a third less richer than what they would normally be. So your reward to risk ratio, your reward is the premium that you would get, your risk is the margin that you have to put up, has just dropped. So ROIs on all of these selling puts, selling calls have dropped. So it's not as attractive as it used to be on a reward risk basis. Well, which one is it? If we believe the VIX, if you look at the VIX and you say, well, since market participants are not positioning for a sell-off, they're less likely to initiate a sell-off by selling because they're not protected. So perhaps they're positioning either for a hold into the end of the year and hoping for a rally, or to buy into the rally. I don't know at this point. I want to see what happens on Monday and see what the pricing action is on Monday. But we're sitting at 376.35 on the SPY. We're below the 390 we were earlier in the week, or earlier before the Fed meeting, but sitting well above the 35 that we hit on that was the CPI day, where it dropped to 35 in pre-market, but from 9:30 onwards it just continued to go up. So we're kind of in the middle of the range, but VIX is dropping. And we have this divergence over here. So on Thursday, as the market was going down, I was seeing the VIX going sideways, and I thought, I'm not leaning into that. I don't know if I believe that move, so I just did nothing. I didn't know what to expect. And the next day we rallied. I took that opportunity to sell some calls. Most notably, the one that I did was IYR. I sold calls on IYR because one thing I know is we are going higher on rates. That is going to affect REITs. There's no two ways about that. And I have I think minimal, maybe one REIT that has pure office exposure. But for office REITs that have just reported earnings, I've noticed that as a category, they had negative net operating income more often than not. So with that, I'm a little negative on a bigger index, not in any one particular name. IYR has rallied a bit, but they still have a fairly low dividend yield compared to where other recession dividend yields would be. So I was more than happy to sell 83 calls for November on IYR. All right, let's just go into the VIX a little bit more here. Here's a longer term chart of the VIX, a 1-year chart going back to early November of last year. And you can see the 36 point for a while. When the VIX hit 36, it was a signal to buy. Markets bottomed at each of these, and it was a signal to buy. And the VIX dropping is the market rising. So all of those signals were fairly good. Didn't get to 36 this time. I'll pull back to around 34, and now we're sitting somewhere around 33. So volatility isn't increasing as much each time. But the bottoms are increasing, right? You have these bottoms that are increasing. This was the summer rally. This gap here, there's Jackson Hole, is like, holy shit, we misjudged that. And down the market went and up the VIX went. So the summer rally was the pivot story. And, volatility just kept dropping. The market just kept rising. It's going to happen. It's going to happen. It's all over. And here we're somewhere, if you extend this over, we're somewhere around 20 on the VIX. We're sitting 24.55 right now. This is just a little under 34 up here. This is 20 over here. So we're getting close to what would be a sell signal on the S&P, which is a VIX somewhere around 20. A buy signal is, well, it just keeps dropping, right? But you kind of have this going on, this kind of thing happening on the VIX. Pivot story is dead. It should be dead, and that word should be retired because it's been used wrong all year long. Let me back out some of this stuff here. So this is what we've seen over the course of the year. The SPY has been making lower lows. So over the course of the year, you have lower lows on SPY, but if you look at the VIX, it's lower highs on the VIX. If the S&P drops, the VIX tends to increase. So if it drops again, you'd expect that it would do this kind of thing, but it's not. It's making lower highs, but it is making higher lows as well. So it's not too willing to get down before the market gets to a point where market participants say, okay, you're going too far at this point. You're not really pricing in the situation. Where do we go from here? This is interesting. That divergence last week, along with the move on the US dollar on Friday, all of this is suggesting to me that for the rest of the year, we probably have no real good reason to sell at this point, but also no real good reason to buy. So there's no real good reason for me to buy puts to protect myself, but that does not necessarily mean we're going to have a rally. So I am more willing to sell calls at this point on individual names, because individual names will have volatility smiles, whereas indexes have volatility skew. I'm going to get low implied volatility here. I'm going to get higher implied volatility there. And I did say last week that I feel that November was probably the last good month to sell calls on the SPY. And I'm feeling that way unless we have some big sell-off and the market realizes that, oh my God, we were wrong. We're in the wrong paradigm. Things are going to be a lot worse. We just didn't see it. And then the VIX spikes. I don't know that that's going to happen based on the action that we had this week although we do have some risk events this week going on. The action in the VIX is telling me that there's not a lot of fear going into the end of the year on the index. This is telling me the lower lows on SPY, lower highs on VIX, along with what we saw on the previous screen, that the premiums for selling calls are getting less rich, poorer and poorer. We know that, you know, you have skew on indexes, but you have smile on individual names. I'm probably going to move my call selling down from the index to individual names that I feel will be challenged in whatever environment we have coming up. All right, let's look at SPY. Forward 4-quarter EPS is 226.72. After this screen, we'll take a walk through this week in earnings and the economic calendar. But we'll see there that the forward 4-quarter EPS is 226.72, which is coming down. That's quite a bit. S&Px closed 37.70, gives us a 16.63 multiple on the index. There we are right here. Nothing exciting on Monday. On Tuesday, quite a bit. You got your midterms on Tuesday. I don't know so much that it's going to be surprising. The end result. I think the polls are right. I think the Republicans are going to make significant gains on that, which means you're going to have a do-nothing government that's going to become even more do-nothing at this point. Lots of Fed speak on November 7th. Collins, Mester, and Barkin. Barkin will be barking. November 7th. He's going to be barking again on the barking again on November 9th. And then November 10th, Harker, Logan, and George. And in Canada, Meldrum on November 10th as well. So November 7th, November 9th, November 10th, plus you're going to get US CPI first thing in the morning, 8:30 on Thursday. So you have the midterms on Tuesday, which I don't think is going to change much. I think if the Republicans come out ahead as is expected, I think the market is going to go, oh, okay, that's pretty good. I don't know that the market is going to be negative on that, because there's a belief that the Republicans are going to be yelling at the Fed much, much more. That they're going to do what Trump did in 2018, which is tell Powell, you got to lower rates. You got to lower rates. I think they'll be pushing for that, and we'll find out if he bends to their will. But I think that the market will probably be saying, well, at least somebody will be yelling at them, you know, and so make it uncomfortable for them. I don't know that that's a big event. This is going to be a big event. If it comes in lower than expected, you can expect the speeches from these guys to really change. And they will get even more, you know, they'll be barking even louder. But if it comes in higher than expected, then, well, we're going to be going higher for longer. But that message is there at this point. So I'm not even sure if the CPI report coming in hot or not dropping at all, I'm not even sure that that's going to have much of an effect. But what I will be watching is the VIX going into Wednesday night. So the VIX has been dropping, and going into Wednesday night, if we're doing this or even doing this going into Wednesday night, I think the market at that point is saying, it doesn't matter what the number is. We don't care. It doesn't matter what the number is. And they'd just be looking past it saying, you know, it doesn't matter to us. We get that there are lag effects, and the inflation number is the way it is because the rates just haven't caught up with it yet. That's all. It'll be some version of that. But if I see going into Thursday, I see the market doing this on the VIX and I see it elevating, I'm going to say the market is still very concerned about that data point. I should be concerned about that data point. Then I will. So let's look at where we could potentially be in the market, what the distribution of prices, the most likely distribution of prices could be. The low here on a closing basis, 357, that would be 15.75 times the forward earnings. That is also a technical support line, which is 19 points down on the SPY from where we are, or 190 points down on the index. 140 points up, you hit your first resistance at 390, and we did have trouble at 390. And getting to 395, which is your next resistance level, is roughly about 17.5 times earnings. Well, actually, 17.5 times earning is slightly above the 395, which is your next resistance, but they're so very close together as to be a common resistance. 17.5 times forward earnings plus, the technical resistance at that level as well. 390 is going to be tough to get through because there isn't really a lot of compelling reasons to buy. And I think 357 will be hard to push through at this point because I don't know that there's a lot of compelling reasons to sell. We know where we are, we know where inflation is, but we can see the jobs report, we can see earnings, we could say, well, those are pretty good. Inflation's pretty bad. That means it's bad for interest rates, it's bad for the economy, but the economy seems to be holding up. So it's like, well, right now we need to wait for one of them to break. If inflation breaks, we're going up. If the economy breaks, we're going down. I don't know which one breaks first, but there we are. So the week coming up, I think this is going to be the big number here, CPI. I think this will be a ho-hum thing. I don't think it's going to be that exciting. I think it's pretty much in the price, what is to be expected at this point. And my signal will be the VIX. I'll be watching that, and if nobody is concerned, well then, I'll take my cue from that. Okay. There it is for November 4th. Last week, even though it said October 28th, when you called up the PDF, it was for October 21st. So, I guess they made a mistake there. Here is earnings season so far. Not as beautiful as the other ones were. Q1, Q2, it's common to see the earnings revisions drop into the earnings season, but then each of them accelerated way beyond where it was when before the forecast came down. This is not. An earnings season is pretty much over. We got 1 week coming up here where there's 4 or 5 significant names, but that's really about it. We're pretty much at the tail end of earnings right now. How many have reported here? Do we have that number up here? Let's see. During the week of November, 31 companies are expected to report this week. It doesn't tell me how many have reported here. 428 of the 500. There it is right there. 428 of the 500. Pretty much at the tail end of earnings right now. So I don't know that earnings can give too much of a boost to the market, nor do I think that earnings can really take down the market at this point. So I think earnings are really nothing more at this point. There might be some individual name risk left in earnings, but I don't know that there's any market risk left in earnings. Let's continue down here. This is revenues versus expectations, up 1.9% on revenue versus expectation. This was earnings, up 3.5% versus the expectation. Let's go down and see our forward earnings, page 10, is it? Page 10. There it is right there, 226.72. The current year, we're expected 220.91, down, I think earlier, before earnings season, was sitting at 225, sitting down at 220.91. And the forward quarter went from 230. We were as high as 234 when it began, down to 226, which is a significant drop, right? Who's reporting this week? Let's see what we have here. This is November 7th. There are a couple interesting ones. Take-Two, and you have Activision reporting. You have some energy companies as well. Disney is in here somewhere. There they are. Disney is on November 8th. News Corp, I don't know if that's interesting for anyone. Occidental, there's Warren Buffett's play. DuPont, I don't even know if that's interesting anymore. Even though they're a significant company, they seem to have gone really nowhere very much. D.R. Horton, that'll be interesting. I'll be watching that. Look at that estimate, 5.09. A year ago, 370. Right, so D.R. Horton, that's going to be interesting. If you're into casinos, there's Wynn Resorts, and I think November 10th. Not a lot interesting. So just a couple of interesting names this week. Friday, nothing on Friday. I think this week is dominated by a minor and a major theme. The minor, I think minor is the midterm elections, and the major one is CPI. Okay, our calendar for the week, or our risk event for the week, going November 7th, midterm elections going into the evening. At 3 p.m. you get consumer credit, but it's very backwards looking. It's for September. But if it comes in more than the forecast, it will begin to feed that story that the consumer is under pressure. They're relying more and more on credit to get by. We have seen that the C component of GDP over the 3 quarters of this year has been dropping. Third quarter, there's less contribution to GDP coming from the consumer than there was in the second quarter. So we are seeing that. So a higher credit change would begin to fuel that. The consumer is under pressure. The consumer is weak. Then you have some Fed speak. Just in case you didn't understand Powell last week, they're going to repeat that. Midterm elections that night. I don't expect much to happen. Usually when there's political things like this, when there's an election, the best thing to watch is the US dollar. Grab any pair that you're interested in, or look at the DXY and just watch the US dollar into the evening. Currencies trade 24 hours. So you can watch that. Also, if you have Globex, you can watch the S&P futures to see how it's responding as the results are coming in. But other than, the minute-to-minute volatility that you would expect, I don't know that it's going to be anything significant. I think the market is pricing in exactly what everybody expects at this point, and I think that what everybody expects is probably going to come to fruition. It's that would be the outcome. This is the big event here, 8:30 on Thursday morning. You have inflation core and the inflation rate year over year. I don't know that these two are that interesting to me because this is just year over year. It doesn't give me any indication of the trend in the months. I prefer to look at these two down here. The inflation rate month over month, or the core month over month, is really the only interesting one. Not too interested in the headline. It's just more the core. Previous was 0.6, looking for 0.5. If it comes in much lower than that, that is going to be extremely bullish going into the end of the year. If it comes in higher, I don't know. That's the thing now. I know that a lower number is going to be really bullish. Will a higher number be bearish? I don't know. You had the market, which seemed to, shrug off the October one. Sure, it hit a low in the morning, but it just rallied after that. You had the move by the central bank last week, and we still had this rally on Friday, even with a very robust jobs report that, and a VIX that seems to be dropping. There doesn't seem to be any concern. I don't know if a hot number will cause a sell-off, but I do know that a lower number will cause a rally. What I'm going to do going into this one is I'm certainly going to be watching the DXY and the VIX, because those are going to be the two signals that tell me how the market feels about that number. If I see a rising VIX and a rising DXY going into that number, I know the market has some concern about the number, which means if it comes in hotter, there will be a sell-off. But if the DXY and the VIX simply are not responding in front of that number and it comes in hot, I would not bet on a sell-off if it's a hot number, which means that any kind of sell-off on that number in pre-market, I'd probably be looking to buy that dip. Again, depending on where the DXY and the VIX are. So that's what I'm going to be watching going into that. Now, if I expect there to be a rally or a sell-off, once the market opens, and you can actually trade because you can't trade options in the pre-market on individual names. Once the market opens, I will already have a list. If I think that, no, I need some negative delta, I will already have a list of names, individual named companies that I want to sell calls on. If I feel I need to add positive delta very quickly, I will already have a number of companies that I will be selling in the money puts on. In the money means if they're at $50, I'll sell a 55 put. Because I would expect, for December, because I would expect them to rise to that 55, thereby capturing that whole premium. So I would be selling out of the money calls, I think, on individual names if I think if the VIX and the DXY were elevated and we get a number that we should be bearish on. But if we are bullish, if the market just doesn't care about the number and we are bullish, I will be selling in the money puts on individual names, but I just don't see a lot of value in the premiums the way the market is pricing them now to go to December. As I said, I think November was the last good month here for premiums on the SPY. Now I'm going to move them down to individual names, the individual names that have higher implied volatility. And that is it for this week.